Welcome to this explainer. Today, we're diving into a really fascinating real-world case study on corporate agility, specifically in the energy sector. We're going to break down how Exelon Corporation's Q1 2026 earnings basically reveal this dramatic real-time boardroom pivot. It's a direct response to some intense pressures on the electrical grid and, honestly, an incredibly tricky regulatory environment right now. To kick things off, let's just put a massive number out there, $7.24 billion. That was Exelon's Q1 revenue. It represents an 8% year-over-year gain. And what's really wild is that this beat Wall Street estimates by over $150 million. But, behind this massive top-line revenue beat is actually a really compelling story of a company rapidly shifting its strategy just to keep those numbers growing. So here's how we're going to unpack this. First, we'll hit the Q1 2026 financial snapshot. Second, the regulatory headwinds and affordability issues. Third, we'll look at their pivot of capital toward transmission. Fourth, cost controls and margins. And finally, we'll wrap up with valuation and the future outlook. All right, starting off with Section 1, the Q1 2026 financial snapshot. Now, despite a remarkably tough regulatory climate, Exelon's foundational numbers, they remain really, really solid. Not only did they beat Q1 expectations, but they confidently reaffirmed their full-year and long-term earnings targets. We're talking an adjusted operating earnings per share of 91 cents, cleanly beating the 89-cent estimate. And of course, there's that massive $7.24 billion in revenue we just mentioned. But what's crucial here is that even while shifting billions of dollars in capital around, they reaffirmed their 2026 EPS guidance of $2.81 to $2.91. Plus, they maintained their target long-term EPS growth of 5% to 7% all the way through 2029. Honestly, it's a huge statement of confidence from the management team. Moving on to Section 2, regulatory headwinds and affordability. So let's get into the actual complications Exelon is facing on the ground, specifically this intense tension between necessary grid investment and everyday customer bills. To really grasp what's happening, we have to talk about the affordability imbalance. This is essentially the growing friction between flat utility costs, which is the part Exelon actually controls, and soaring regional generation supply costs. Get this, in the Mid-Atlantic region, these supply costs have skyrocketed by up to 80% over the last 5 years. That is a massive spike. Now, Exelon doesn't control the power supply side of the market, but that spike creates severe affordability pressure for their customers. And inevitably, that bleeds directly into how regulators view any request for a rate increase. To put that into perspective, Exelon's CEO, Calvin G. Butler, summarized the stakeholder feedback pretty bluntly. He said, "If you could partner with us to address the affordability issue and lean in, timing is not the best right now." That direct pushback from stakeholders and regulators led to an absolutely massive, unprecedented decision from management. Exelon completely withdrew their recently filed PECO electric and gas rate cases in Pennsylvania. They listened, and they decided to pull back rather than force a rate hike during a localized affordability crisis. But for anyone tracking the stock, this regulatory tension isn't just political theater, right? It carries real, heavy financial consequences. Because of this operating environment and those withdrawn rate cases, PECO has actually been placed on a negative credit outlook, and it's currently under review for a credit downgrade. So it's this incredibly delicate tightrope walk between keeping customers afloat and keeping the bond rating agencies satisfied. Which brings us to Section 3, pivoting capital to transmission. To counter these headwinds, management executed this massive, agile shift in their $41.7 billion capital plan. Basically, they pulled $1.1 billion away from local distribution deferrals and reductions in PECO and BGE, which are the exact areas facing that fierce regulatory pushback we just talked about. And instead, they poured $1.5 billion into high-return incremental transmission investments and data center interconnections. They're literally pulling money from a high-friction area and dropping it straight into a high-growth, lower-friction area. It's a textbook pivot. And the impact of that capital reallocation is stark. While their total annualized rate-based growth is projected at a totally respectable 7.9%, their projected transmission rate-based growth, that is now supercharged to 16% annually through 2029. This shift creates a much stronger, far more resilient growth engine for the entire company. So what exactly is driving this massive transmission surge? Well, we're looking at $1.9 billion in competitive bids for MISO Tranche 2.1. On top of that, they have an incredible 18-gigawatt high-probability data center pipeline. They've even secured $1 billion in data center collateral via FERC agreements. And all of this is happening as they attempt to bypass a heavily delayed PJM interconnection queue, where, get this, a staggering 54 gigawatts of power are currently stalled out by siting, permitting, and supply chain issues. It's an absolutely massive amount of pent-up energy demand. Let's shift gears to Section 4, cost controls and margins. Now, beyond the capital pivot, management is taking some very real and honestly sometimes difficult internal steps. They are trying to hit a massive $350 million operations and maintenance savings target by 2027 to protect both their profitability and their customers' wallets. Step 1, accelerating AI and technology transformation. Step 2, aggressively prioritizing only the highest impact IT projects. Step 3, reducing their reliance on outside contractors. And Step 4, implementing targeted voluntary employee separations. They are basically trimming the fat to ensure the business runs as lean and efficiently as humanly possible. Which brings us to a really crucial metric, operating margins. Exelon's Q1 2026 margin sits at 22%. Now, you might be thinking, well, they clearly trail peers like Duke Energy at 26% and Dominion Energy at 29%. But context is absolutely everything here. Exelon's margins have steadily recovered from a trough of 17% in early 2024, all the way up to this solid 22%. So the gap is narrowing, and those internal cost control measures we just went over, they are undeniably working. Finally, Section 5, valuation and future outlook. So, with the operational and capital pivot crystal clear, what does this actually mean for the stock's valuation? It all boils down to one direct question. Is XCI currently undervalued at its current price of roughly $45 per share? Let's apply all the financial data we've just unpacked to some independent valuation models to see what the numbers actually suggest. Well, the answer is pretty revealing. Independent analysis from Ticker's mid-case valuation places Exelon at $68 by December 2030. If achieved, that represents an incredible 50% total return from its current trading levels. Let's break those valuation numbers down just a bit further. The current price is hovering right around $45. The TKR mid-case valuation is $68, which gives us that 50% upside we just discussed. Interestingly enough, according to the source data, their bear case is listed at $70, and the bull case sits way up at $93. The margin of safety looks quite strong here. But, and this is a big but, it comes with a major caveat. It requires management to perfectly execute this transmission pivot without suffering any further regulatory erosion on the distribution side of the business. Which leaves us with one final provocative thought to wrap up this explainer. As power demand absolutely surges, driven heavily by data centers, and as regulatory battles heat up over customer affordability across the country, can Exelon's agile management pivot turn gridlock into a 50% market upside? I challenge you to consider if Exelon's strategic agility is truly enough to overcome the massive structural supply issues facing the U.S. energy grid. Thank you so much for learning with me today, and keep asking those big questions.